your time to be part of this session tonight. I believe you had a fruitful week and you're also looking forward to a new week. So we also appreciate those who have paid to make sure that the classes continue, even though some of them they won't be able to join due to some commitment, but they have made sure that they commit also to pay to push the classes to go. So today, because we're going to continue to dwell more on the stock market, I've discovered that we differ as individuals. There are those who also prefer to use both the stock market, but also invest in banks. So I just want to show you part of the system of banking, so that you'll be able that when you invest in the banking system, what's going on there, because not all of us who are going to invest only in the stock market, but some will also prefer to invest in the banking system. And when it comes to the banking system, I've noticed that people they always do some mistakes. One of the mistakes which they do when they do their investment, number one, they don't ask questions. And what decide your investment most of the time is your capacity to ask questions which are related to your investment, because salespeople most of the time what they do, they are looking to score the sale so that they will get more commission. And then when at the end of the day, as an investor, you do suffer. So you must be good in asking questions which are related to your investment. So the other thing which you need to understand when it comes to the banking system is that the banking system is also broad, but if you study it the way it is built, the banking system is created to benefit the owners of the banks. It's not created to help us to be wealthy. We are going to see from the numbers which are going to display on the screen today to really understand that the banking system, the way it operates, it only caters to them and it favors them and gives them the advantage of having the cash flow, using our cash to build their own banks. But because we also grew up in this system of bank, and it was the only source that we were introduced to, like we knew that the bank is the safest place for us to do our investment and everything. But when I look at the system, the way it is designed, the system and the policy around the banking system, they don't favor us at all. Hence, me individually, I don't prefer to put my money in a bank in the name of investment. I can only put it if I know maybe after 2 months I will need this kind of money and it's a huge amount. Like this month I had a need of a huge amount, so I'll just put it there for those maybe 1 month or 2 months, because I know I'll need it within a short space of time. So when you do your fixed deposit, when you go to a bank and do your fixed deposit, you have to understand that there are two options which you can go for, and those two options, let me just put them on the screen. If you are going to do a fixed deposit investment in the banking system, you are going to have two options. And then these things will also help us now when you go to the buying of shares, because they relate a lot. So it's either you're going to put your money in a nominal interest rate, or you're going to put your money in effective interest rate. So we have these two options, but they differ. They differ. The nominal interest rate and the effective interest rate, they differ. So people, they just say, okay, I just want to put this money. And what I've noticed about the bankers, most of the time when you say want to put the money and then you don't you ask them, or you don't tell them that no, I'm putting this money, I want it to be on an effective interest rate, or I want it to be in a nominal. What they're going to do, they're going to take it based on whatever it is they're going to decide there. Even if a person can take your money and put in the effective interest rate, whatever amount the person is going to receive, they can transfer it into their own space, unless if the system it is created in a sense that they have to account for everything. So the nominal interest rate and the effective interest rate, they do differ, and this information I'll also request us that let us not keep it to ourselves. Some of you have parents who are investing in banks who won't understand the system of the stock market which we are using. So if they're going to invest in the banks, you will be the one who's responsible to help your own parents to say, okay, if you're going to invest in a bank, this is how things works, or this is how we have to go about it. So the nominal interest rate, it does not take into account the compound period. And then the effective interest rate does take the compounding period into account, and thus is more accurate measure of interest charges. So I have to break it in a simple format. When you speak of a nominal interest rate, it means the percentage of your growth which they give you from the first date. Let's say you want to do a 5-year investment. If they say your investment is going to be 10%, it means you have to calculate 10% from year one up until the last day of your investment. So it will remain as 10%. It does not have compounding. It will remain as 10%. So, but when you use the effective interest rate, the effective interest rate from the beginning, or like from the beginning of the first of your investment, it will be similar with the nominal interest rate, but on the second year, that's where now the interest which you have earned is going to join the original amount which you have invested, and then they come together and they form an amount, and then the amount they join and they continue. So with a nominal interest rate, if it's 10%, it means year one, you receive the 10% of your investment. Year two, you receive the 10%. Up until to year five, you receive the same thing from the first year to the last year. You will receive the same thing. That's how the system of banking works. And then just imagine, we are in a country where we don't have any bank that is able to give you more than 10% in return, meaning your money is not only going to be stagnant due to the interest rate, it's also going to be stagnant due to the economical factors, and also the increase in the cost of living. And then above all, what is going to affect your money is the issue of inflation. So the nominal interest rate, though it does not take account in terms of inflation, but even if it does not take count of inflation, you have to understand this. When the inflation is high, whether they say it does not take the inflation or what, the issue is that when the inflation goes up, it means the pricing of everything is affected, meaning the value of your money goes down. Even if they can say, no, with nominal interest rate, we don't take count of the inflation. But at the end of the day, whether they take it or not take it, your money there is either is gaining value or losing value. But with the rate which the banks give you, your money can be there but not gaining value, because the cost of if you can check out the cost of living is moving faster. It's moving faster than those rates which the bank gives you. So the only thing which I can say is that the security can be there. The security can be there in terms of your money, but in terms of growth rate, if you're going out to take the rate which they give you, compare it now with the inflation, it's another subject. Because when you study these numbers, you notice that now I'm not making money there. I can assume that I'm making money, but the measure which you have to use in terms of measuring the value of your money is the measure of inflation. The inflation will tell. And then though these guys, they are saying the inflation is in 5%. Personally, I don't think it's the right measurement to measure inflation by say it's 5%. You need to measure inflation based on the cost of things around. If you want to find the right space of measuring inflation, you need to measure it with the cost of things around. So let's just have a proper example on the screen on how to calculate a nominal. We'll start with the nominal interest rate, and then later we're going to do the effective interest rate, so that you will see how these things goes. Let me just put it here on the screen. Okay, that's the calculation of a nominal interest rate. I'm going to break it down for you. So you can think of a nominal interest rate as a price sticker. So when the bank says you'll receive 8%, we're going to use 8%. When a bank says you'll receive 8% in nominal interest rate, it means you will receive the same amount of interest annually until the end of the agreed period. In other words, you're going to receive 8% of your money from year one up until the 5th year. We are using the period of 5 years. So the 8% of 20,000 is 1,600. Meaning, if you put 20,000 in a bank for a period of a year, your interest if they give you 8%, I'm going to give you the rates of banks, the real rates. Now I'm just using example. I'm going to give you screen. I'm going to show on the screen. You see, study the rates. You will be surprised. So if the bank says you're going to get 8% in a nominal interest rate, if you put 20,000, the 8% of 20,000 is 1.6. In other words, at the end of the year, the return of 20,000 will be 1,600. Then so if you put this 20,000 rand for a period of 5 years, because the 8% of 20,000 rand is 1.6. If you put 20,000 in a bank with an 8% interest rate, it means at the end of 5 years, your money will germinate 8,000 profit. Just imagine. I want you to have a strong balance here, guys. If you put 20,000 in a bank, if you put just 20,000 in a bank with an interest rate of 8%, which is going to be equivalent to 1.6 in a year. Remember, don't forget this thing. When times move, things also moves. So the value of 1.6 can make sense from first year, but from the third year, the value of 1.6 will now be less. So you must also consider such factors if you are going to invest in a bank, that the value which they give you from the first year in a long period, well, as time goes, the cost of living, your investment will suffer due to the cost of living. In other words, at the end of the day of receiving or at the end of the day of your agreement, you will see that the value of your money is now less. But the aim is not to put money in spaces where money will lose value. The aim is always putting money in spaces where money will gain value. But due to stuff like inflation, economical changes, obviously your money will start to lose value in such spaces, because the growth rate of 8%, guys, is less. It's real less. That's why okay, we're going to see when I share the real measures which the banks use. That sometimes for me, I'll say it's better for me to invest in bonds than to invest in banks, because if this 8% is going to be my interest, the value of my money, it's going to be something else. So when you look at it, if it's 8%, then the 8% of 10,000 is 1.6, then 1.6 times 5 years is going to be 8,000. In other words, after 8 years, your money will be 28,000. So a simple question: can you wait for 8,000 for the whole 5 years? Even if that money was exchanged maybe to buy tomatoes or to buy some stuffs, I think you should have done better than to wait for the whole 5 years just waiting for 8,000 in terms of interest rate. So this is how nominal interest rate works. The nominal interest rate, the interest remain fixed. In simple language, the interest rate which the bank gives you, it remains fixed for the whole period. Whether you agreed for 20 years, whether you agreed for 10 years, it remains fixed. In other words, if you can take this same 20,000 and invest it in the nominal interest rate in any bank that gives you 8% for 10 years, your profit will be 16,000. Just imagine waiting for the whole of 10 years, waiting for 16,000. And then if you calculate 16,000, you won't calculate it as your own profit. You'll calculate it 16,000 minus the value which it have lost from first year to the last year. You will see that your money does not have value at all. You have invested. The one who will benefit from your money is the bank, because the bank will make sure that they trade your money in spaces where they're going to make more money. So in simplicity, if you're going to go for a nominal interest rate, you must have maybe a lot of money to be able to, but even a lot of money, will see that even a lot of money does not make sense in terms of nominal interest rate. Now let's check the example of calculating the same 20,000 using the effective interest rate, how it works. Let me just go into the screen. Okay. Using the same method, calculating the effective interest rate. Let's see. So if you invest the same 20,000 and with the 8%, on the first year, the 20,000, it is going to be 1.6, obvious. But that's where everything starts to change, because on the second year, if we invest on the effective interest rate, on the second year, the money won't be calculated with the principal money. The principal money is 20,000. The profit which you have made on the first year is 1.6. So on the second year, if you invested in the effective interest rate, the 20,000 now will be 20,000 plus 1.6, which is going to be 21,600. So now on the second year, the 8% is going to be calculated like this: 21,600, the 8% of 21,600, which is going to be 1,728. That's what you're going to go. And then when you go to the third year, it's going to carry now the extra 1,728 which you have made, which is going to be now 23,328. So on the third year, it will be the interest rate of 23,328, because we call it the law of compounding. So the interest which you are making in effective interest rate, it carries along with the principal money. Unlike the nominal interest rate, the nominal interest rate remains as it is, but the effective interest rate carries the principal money and join the principal money to do what we call it a compounding. So now, as time goes, it compounds. The money compounds. It compounds around that percentage which they gave you. If you go now to the fourth year, it will move from 23,328, and because the thing is this: the more it increases, the more it has power in that percentage which they gave you. Because if it's 20,000, it will remain as 1.6. But if it's now 21,600, now it carries power, and then it goes now from 21,000 up until 23,000, and it goes like that. Then at the end of the year, at the end of your investment of 5 years, there will be a difference, because in the nominal interest rate, the amount it was 8,000. The profit, it was 8,000 which you have made. But here on the effective interest rate, the profit which you have made is 9,386. 9,386. That's how much now you have made here. The difference is the compounding. Is the compounding, because on the other hand, there on the nominal interest rate, it remains fixed. But on the effective interest rate, the principal amount meets now the profit, and then it comes together to come against the 8% which they have given you. So now here your profit will be 9,386 at the end of a year. In other words, at the end of the year, we're going to, at the end of 5 years, we're going to have 29,386. So when you look at it now, it means if you use effective interest rate, you only gain 8,000. But if you use nominal interest rate, you only gain 8,000. But if you use effective interest rate, you have the compounding, and then you have extra 1,368. But if you use the nominal interest rate, the 1,368, you won't get it. You will lose it. So when you go to a bank, or if your parents go to a bank and say they want to invest in a bank, always advise them not to go for the nominal interest rate, but they must go for the effective interest rate, because the power of the effective interest rate is compounding. I was reading the story, which is so interesting to me. I want to continue to read the biography of the Rothschild family. The Rothschild family is the family from US, because most of the guys from the US, they use the advantage of families. While we as Black people, that's why we struggle most of the time. We don't have the ability to come together to build something of value. But most of those guys from US, you'll notice, in fact, most of those successful companies that you see today, they are family businesses. You can look at businesses like ShopRite. It's a family business, ShopRite. You can look at businesses like Pick n Pay. Those are family businesses. So you look at it from one generation to another generation. Don't now Pick n Pay is struggling, and then most of the shops are closing because the management, I don't know what's going on with the management. There's a lot happening there. But when you look at those companies, then they were not started today. Those are family business. Those are family businesses. So we as Black people, that's why we struggle most of the time. We don't unite as family. Like, even if we are from one mother, one father, we don't know how to come together to build something of value. But there is something which I've learned from the Rothschild family. The Rothschild family, that guy, before he dies, because like the wealth of that family, if you don't know it, you can think that those guys have just made their money now. That guy, before he dies, I was reading his history, died around 18 something there. So when he dies, they say they gather together all the family and then call his lawyers, and then he said the 1 million, but they said he had the 1 million that time, which it was a lot of money. The 1 million which I'm having, put it in a trust and then lock it for 100 years. And I just imagine it means everyone who was there with him won't be able to enjoy the benefit of that man. Say lock it for 100 years. And then they lock it for 100 years in a certain investment. And then after some years, the wealth that you see today from that family, if you read of them today or you see them today in America, those old men in America called the Rothschild family, they are the result of that guy who said in 18 something, who said, let's put the 1 million in a trust and then lock it like that. And if it's locked in a trust, know that no one's going to be able to withdraw the original or the principal amount. The principal amount will remain as the principal amount. They will only enjoy the interest of the principal amount. So when you lock it for 100 years, after the 100 years, the money they said it had made 13 billion US dollars of interests. And then the family split that among themselves. Obviously, the generation that was present when he signed this deal, all of them, they passed away. But this guy was able to plan for the next 100 years. And then it drives me crazy. I was thinking and say, do I have any plan that is covering the next 50 years? Like it caught me to sit down and say, I must think like this guy. Okay, it's okay, I've covered the present generation, but let me think of the next 100 years like this guy. What is it that I can do to think of the next 100 years? And then remember, guys, the power of compounding is critical when it comes to investment. The power, don't forget this principle, the power of compounding. You don't need 50,000 to start to invest. You can start to buy shares as little as 100 Rand every month. And then just put it there. It won't make sense now when you do that. But as time rolls, that's the part. That's why you're going to see the power of compounding, because your compounding will be on the capital gain. Your compounding will also be on the dividends. But when you start to do it now, it doesn't make sense. The guy the guy of Rothschild's family, when he placed that 1 million US dollars in that trust, it was not making sense. But after the 100 years, it was able to compound up until it reaches 13 billion US dollars. And then when I read their history, they said those guys, none of them will ever be able to go back to work again. All of them, from one generation to another generation, their duty will be transferring their wealth to one generation to another generation. They have wealth, they are not rich. A rich person is a person who's having a lot of cash. A wealthy person is the person who controls the means of production. So those guys, they don't have cash. They control the means of production. They are part of America's economy. They're not just guys. They're not just guys who are waking up and then having headaches of school fees. They don't think school fees. They don't even think globally. They think above what we see and what we imagine. So we need also not to break our accounts, but we also need to break our mentality, because problem with most of us Black people, we don't know how to break the mentality which the society has implanted in us. We need to break that mentality. So if you look at these stuff like your 8% compounding, 8% going to 1.6, 23,000 goes like that, you look at it and say, do I want to go this route of a bank where the bank, they decide this percentage based on their greed? Or do I want to break the system and go to bonds or to go to the stock market? So it's all about the mentality which we possess. Let me just put on the screen something which the banks uses to, like, I want to put the rates which the banks are using to measure. No, it's not example. Now I'm going to put the proper rates which the banks are using to measure your investment. Let me just scroll. Okay, let me just find my space here. I want to scroll. Okay, we are in now. Okay, let me just go. We're going to take at least a few examples of the interest rates. So I'm going to give you interest rates and banks. So let's go now. Okay. Okay, let's go. If you invest 10,000 in, let's go to 6 months. Let's just start from 6 months. Let's just pass. Let's just go to these stuffs are not written by me. These are stuffs which are from the original from the banks. So if you invest 10,000 I'm just going to give you the result based on different interest rate. So if you invest in 10,000 Bidvest, nominal interest rate is 5.86. So effective rate is 6.02, which is compounding. So in other words, your 10K at Bidvest after 6 months is going to be 297. In African Bank, after 6 months, is going to be 296. Absa 270, FNB 270, Access Bank, and then remember Bidvest, they don't allow you to open an account. There are some criteria which they say if you earn this or have this are going to allow you to open. And then Capitec is going to be 253. And the Standard Bank is going to be 247. NetBank is okay. I don't know if you think of putting money at NetBank, forget about NetBank. NetBank is the worst of them all. NetBank, after 6 months, your 10K, it will be worth 176 rand. Just imagine waiting for the whole 6 months just to get 176. You can make this money in a day. 176. But because people will just go for banks as it is. Let me just fast forward and then have long, let me just check 12 months. No, let's use 24 months. Let's use 24 months now, the same 10K. So if you put 10,000 in SA retail bonds, is in 8.75%. This one, SA retail bonds, it can't be fixed. This one, it is always changing, because SA retail bonds are going to find it on a tax-free account. So if you invest in SA retail bonds, you won't be like always get 8.75%. It can go from 8, 9, 10 to 11. It goes as time goes. So for 24 months, which is going to be 2 years, a 10K is going to be worth 1,868. And an African Bank for 2 years, 10K is going to worth 1,666. Just imagine this, it's so horrible. But the worst is NetBank. NetBank is going to be 950. For the whole 2 years, you're waiting for 950. For me, I can't do stuff like this. Let's just scroll. Let's just scroll and check other banks and see how they are operating. Let's just scroll and check other banks. I just wanna let's use a big amount. Let me just scroll down and get a big amount of 100K. Yeah, 100K. Let's go 100K. Let's use 12 months. Let's use 24 months of 100K. 100,000 in SA retail bond, if it's going to remain 8.75%. In 2 years, 100,000, you can get 18,679. Standard Bank, you can get 17,000. These are the rates which the banks are using. These are not rates. These are not examples. These are real rates. So Standard Bank, if you put it on a nominal interest rate is 8.08, but if you put it on a effective interest rate is 8.9%, which is going to compound as time goes, and then you're going to get 17,484. Investec. But let's go to the worst of all, NetBank. Look at NetBank. After 2 years, your 10K, your 100K will worth 10,607 rand. And then let's calculate that 100,000. If you put it for 2 years, the value of things, it always continue to grow. And in other words, your money is not making money. It's only the bank which is making money with your money. Okay, let me just give the last example, and then after this, we're going now to flip to the stock market and see how the stock market can beat the bank system. Let me just let's use not 100K. Let's go to 1 million. I just want to get 1 million. So if you put 1 million, in a bank, if you put it in Investec for 6 months, 1 million can give you 31,164. If it's 1 million, and then in Standard Bank you can get 30,776 in 6 months. Let's check it annually. In a year, in 12 months, in Investec, in 12 months you can get 74,200. Standard Bank you can get 73,500. African Bank, you can get 72,500, Bidvest 71,000, Capitec 69,000. Just imagine the whole year waiting for 69,000 while you have a million. You can translate that thing to make a lot of money for you. And then FNB 67,000, ABSA 65,000. So let me just check 2 years. So in 2 years, if you put it in Standard Bank, 1 million, you can get 174,839 in 2 years. This is the amount which you can make in 2 years if you put a million in a bank for 2 years. And then just imagine how much did the bank make using your own million. And then if you go, you can check your Investec, you can check your Capitec 159, you can check the Discovery Bank 155,000, 156,000, and then the rest of them all Nedbank. Look at Nedbank, even with 1 million Nedbank for 2 years, they can be able to give you 105,000 or 21 in 2 years. That's what they can give you, Nedbank. So look at this struggle now. And it's a question of, can you build wealth around such stuff? So you cannot build wealth around such stuff because your money is always limited in stuff like this. But the problem with our people, they don't want to be educated when it comes to finances. They think a bank is the best place to put their money. But the thing is that the bank will always get more profit, and when as an investor, you'll just get less. So the bank will be making more while when you are getting less. So now I can't put a million in a bank to get 105. I can't because this man even annually is still little. So for 2 years waiting for 105. In other words, it means my million in a year is worth around 50 something thousand in Nedbank. Just imagine a million worth 50 something thousand in a bank. So it does not make sense. Now let's now transit to the stock market to see how the stock market can be able to build this. So let me go back to my notes of the stock market. Okay, now we are here. Okay, now we are back to the stock market. And then, yes, so when it comes to the stock market, I'm going to share brief again for those who are not here in terms of buying shares. Okay. So when it comes to the issue of buying shares, we said shares is a portion of ownership that you own in a certain company. So when they say you bought shares in a certain company, it means you own a portion of that company, which it comes with some benefits. So it differs on what kind of shares you're owning in that company. So how you make profit in those companies, you make profit through the growth of the company. So when the company is growing, let's say you invested in that company, I won't use percentage, I just use the real money. You invested in that company, they say those shares when you bought them, they were 5 rand when you bought them. But after a year, those shares now they are 15 rand. In other words, your money has grown by 10 rand. So you have made 10 rand as a profit. So now you'll calculate the number of your shares which are having in that company. If you have now 100 shares in that company, you're going to say 10 times 100, then you get the original, you get the profit which you have made from the original amount. So that's how you make a profit. You make profit through capital gain, but you also make profit through dividends. Dividends is the profit which the bank makes, the company makes, and decide to share with the shareholders. So that's how you make money. So when you invest in the stock market, it's for a long-term period. It's not just for today and tomorrow. It's for a long-term period. And then the growth of the stock market, it does not operate like the growth of banks where they give you a fixed growth rate. The stock market cannot be fixed because the growth there happens based on economical factors and also the performance of that company. So for me, I've learned this personally. I've learned, number one, I cannot go to some schemes, whether you're Old Mutual, whether you're any bank, and say I wanna do educational investment for my child. I can't do that. Why? It's because those stuff that are giving us, for me, they don't make sense at all. I just want to give an example. The investment which people they have made in Old Mutual, investing for their kids and says for educational, that kind of man cannot even cover the expenses of university for 2 years. It can't. What they're going to give you there, yes, you'll pay maybe from the early age. but you can't afford, because they say at the age of 17, because a person who started school based on their time, they will finish school at the age of 17. They will finish high school at the age of 17. So even if you can start early to put the money there, by the end of the period, that money won't be able to cover the expenses of university for 2 years. I'm talking about 2 years. And then you do a degree. Most of the degrees you do them for 4 years. So it's a question of what about the remaining other 3 years? How am I going to cover the cost? But in your mind, you'll be having that thing of saying, okay, I do have an educational investment for my child. And then you must understand that the investment which they give you there, it also counts in terms of the someone was asking me then, why do these guys charge us administration fees? Because I said, man, that's how they work. That's how they work. You have to pay them for everything, from moving this to this. They have to pay them. So if now they say my interest rate is 5%, I was also minus the administration fees from that. The charges, I'm going to minus those charges from whatever they are giving me. So if you give me 5% and say educational investment, oh, your 5% is equivalent to the inflation. And then now if you minus 1% of administration, I'm left with 4%. In other words, my money is now below the inflation. In other words, it's negative, not positive. But in my mind, I'm thinking, no, I have an investment for my child. When my child passed grade 12, I have an investment. But that investment, what makes us at the end of the day. And I remember 2 years back in my mentorship program, I told some of my clients and say, tomorrow go, they had some investment, like educational investment, Old Mutual. I told them, say, tomorrow go to Old Mutual and ask, how much are you now having from the investment, and come back to me. And I told them, none of you will come back to say my investment is positive. All of you will come back with negative. And all of them, they came back with negatives. And then some, they decided to cancel all those stuffs and start to invest in other spaces. So for me personally, I cannot go for such things and say I'm investing for educational investment for my child. I can't do that. I rather take that money and invest it either in bonds or invest it in ETFs, because I do have access in my tax-free account to buy ETFs. As you know, it's like this thing, guys. If you want to access your tax-free account, or you also access ETFs, if you have not yet registered your account, just go to your Play Store. But personally, I use Easy Equities. Just go to your Play Store and then search for Easy Equities. And then when you search for Easy Equities, you're going to be able to access those companies to buy shares, but also you'll be able to access the tax-free account there. And also even the retirement, you can plan for retirement there, but you also need some guidance in terms of financial planners. If you want to use that, you must now consult with financial planners to planners to assist you in terms of that. So if you look at these things which I've shared with you based on the banks, for me, they don't make sense, and I can't go to that route. But I'm not saying we should think like me, but that's what I'm laying on the table. If you think like it's okay for you to go to a bank, you'll go, but you will always know that this thing of banks, for me, just sound like a scam. I can't put $1 million for 2 years and get 105,000. I can't do that. And like all these 2 years, my man was struggling to make at least 500,000. It only makes 105,000. It doesn't make sense at all. So now coming back to the stock market, I know some of you have already started the journey of buying shares and buying shares and buying shares. But when it comes to this journey, guys, knowledge is key. Knowledge is key. You must invest in knowledge. You must invest in knowledge to understand, because when you don't have knowledge, you'll be like me back in those days. I'll follow guys and say, oh no, let's buy what I buy. Let's buy what I buy. And one of the common mistakes which I want to share with you, which I did when it comes to investing in stock market back in those days. I remember during the COVID-19, because the market was going down, up and down, up and down. I remember we bought shares, and because they were cheap because of COVID, we bought them. And guys will be like, no, Capitec shares now, guys, have moved from, because Capitec shares, they've moved from, it was 1.4, 1.5. It was reaching, it's either 1.4, 1.5, 1.7 coming back. And then because of COVID, they went back from 1.7 up until they reaches 6, I think 6 to 700. And then everyone was jumping in because they went down. And then later on, returning to like from 6 to 8, 9. And you start to calculate that, okay, if Now they're going to 9 and then 1,000, and you'll be like, no, I have bought these shares with 600 and now they are at 1,000. It means per share I have per share now my value is 400. And then you calculate, if you have bought 50 shares, you'll be like 400 times 50. So it's good, man. Remember, no one was teaching me better and saying, it's good, man, let me withdraw it so that I'll show to people that no, this is the money which I've made. And then treat the stock market as trading. And then I sold out those shares. And then today, sitting down there, when you look at the value of just one example, there were a lot of companies which we bought and sell, and then we're happy to make those small amounts. I was not thinking like the Rothschild family. And when I'm sitting today taking some of those companies, because later on I went back and buy, but the value has already went up. I look at those companies and say, now Capitec share, one share is 2.4. And then me now back in the days, those shares I was able to access them around 600, but now they are at 2.4. And then I started to look and say, if I bought them at 600, and then now they are at 2.4, what will be the value of my investment now? And I started to shake my head and say, but I'm learning, even though I'm learning the hard way. Number one, I'm learning not to be governed by emotions. Number two, I'm learning not to follow crowds, but to study and to invest in right knowledge. So if I didn't listen to those guys, the value will be something else today. Because later on, I went back and now they were 1.2. Then you buy back, but it does not help because you have missed that opportunity which you had in the market. Shares like your time bank shares, they were 1 rand, like 1 rand is 1 rand. Today they're 7 rand. And just imagine how many 1 rands did I had. If it for me, it was not even 1 rand. Now I started to buy time bank shares at 50 cents. They were 50 cents. And then how many 50 cents? Which like if I went straight there and say, let me put 30,000. And because it was 50 cents and just put 30,000 and keep quiet. Now it's 7 rand. I will not even panic to sell now because it's 7 rand. I'll still give them a space to grow, giving them this, but because I was following those guys, no guys, let's jump out, jump in, like it's like we're like playing sort of emotional games, jumping in, jumping out, jumping in, jumping out, jumping in, jumping out. And that was the problem with me, and those are the mistakes which I've made. I never wanted to invest in any mentorship program because I feel like someone will be sitting down telling me I know how to buy. The issue is not knowing how to buy. It's easy. As I've said, you can go to your Play Store and install the Easy Equity app, and then later on you are buying. But sometimes you buy stuff that you don't understand. You sell stuff which you don't even understand again. So when it comes to stocks, we have different kind of stocks. You don't buy any holding that you're owning in your portfolio. It is classified in this type of stocks which I'm going to share. So number one, we have what is so called a common stocks. A common stock, when you purchase a common stock, you gain ownership in a company along with voting rights and corporate matters. Okay, let me just, because these are not, so common shareholders may receive dividends, but these are not guaranteed and can fluctuate based on the company's financial performance. So if you buy any stock or if you buy shares that falling under a common stock, you must know that it does pay, some of them do pay dividends, but the dividends are not fixed. Sometimes they can be less, sometimes they can be higher. So if you buy common stocks, there are a lot of companies which are common stocks. So if you buy from them, you must know that things like dividends, they're not fixed, they can change at any time. So the best thing before you buy, you need to ask yourself, which class does this stock belong to? For an example, I can ask you guys, which companies are you owning in your portfolio? Some you can say MTN, some you can say Vodacom, Netbank, some you can say Anglo American. But if I ask, which class does it fall to? Most maybe you will be confused and say we don't know. So if now you know which class it falls to, it helps you now to engage in the investing with right understanding. And then you cannot know these things like from the beginning. You need to have someone who will be helping you to say, no, we can't have more common stocks, or we can't have the whole portfolio invested in common stocks. Let's have a balance. We can have 5 companies which are common stocks, 5 companies which are preferred stocks, because I'm going to share more and more different types of stocks. So example of a common stock is Shoprite Holdings. So Shoprite Holdings, it has 3,543 shops around the continent of Africa. It has 3,543 shops. around the continent of Africa. So I also have my brother here as well. I'm sure he's seeing that ShopRite is at 3,000. We must also grow our general dealer and then break the continent. You must not think local. You must grow it and then break this continent, and then it reaches different. So with the 3,543, what I also love about ShopRite, they don't buy most of their stuff from anyone. They own the farms and they own everything. So if you own shares in ShopRite, you know that their cost is low. And once their cost is low, it means the growth of that company is easier for it to grow because they own most of the value chain. They don't buy these stuff from anyone. They do buy then, but most of the things we ShopRite have, it comes from their own farms. So we just want to analyze ShopRite a bit so that you will see ShopRite a bit. I mean, or maybe on the next session, I'm going to show you how to analyze the company. So the market capitalization of ShopRite as October 2020, this is the research which we did last year, 2023. It was 367 billion rands. That's their capital share. Like the whole value of ShopRite was 367 billion rands. So you can see that this family business is very powerful. So one share is currently now in 2024, one share is 307 rand 63 cents. So if you want to buy a share in ShopRite, you must have 308 rand in short. So one share is 308 rand. And remember, ShopRite is the #1 retail company in the whole continent of Africa. There is no other retail company which beats ShopRite. You can see, I know you guys, you think like Spar, shops like Spar, Checkers, they compete against ShopRite. Go and check the market capitalization of Spar. You will see that Spar, it cannot even draw closer to ShopRite. ShopRite is standing there by itself. If it was soccer, I would say ShopRite is the Real Madrid, standing there by itself. No competition. Spar is not competing with ShopRite. It's only our minds which are competing, but Spar is not competing with ShopRite. ShopRite is there by itself. So you can see that if you invest in companies like ShopRite, and the other thing which you need to understand, you need to classify your investment based on industries, because you need to have companies which are investing in food. You need to have companies which are investing in medicine. Okay, companies, let's speak of companies which are in food. All of us, we consume food every day. So you know that there will always be a need of food for humanity up until the end of the world. There will always be a need for food. So there is no other way we can compromise and say, now we're no longer eating, we have programmed ourselves technologically. We'll always need food. So you need to check in your portfolio which companies which are in food. And then you list them. And you have your top 5 companies which are in food. And the #1 of them is ShopRite, because ShopRite is the #1 retailer in all retailers in Africa. And then you have those companies who will always need food. Let me go for ShopRite, and start them how they are growing. And then in pharmacies, remember during COVID, companies which are in pharmacies, they've made a lot of money and they were growing. We'll always need medicine. In your portfolio, you have a balance. Food companies, medicine companies, technology companies. Those are the things that we are using in our daily basis. So when you think of investing in a company, you must think, okay, let me go to the industry of food, and then see which companies I can invest into. And then you look at those companies and say, okay, what are the top 5 companies in South Africa that are focusing on food? Because I can't take you to the US market. Let's start in South Africa. We'll see the US market later. Then you list those companies and say, I have ShopRite, and then how much do I need to put in ShopRite? You put that amount, and then you align your portfolio rightly. Don't just jump in a company that you see, oh, this name is, no. Just align your company based on the reality of what you're dealing with daily. So food will always be a need. Medicine will always be a need. So those pharmacies companies, they are there. Those food retailers, they are there. The mining companies are there. You invest in different companies. So when you look at the price of ShopRite now, as 2024, it is 300, and let's make it 308 rand. So during COVID-19, one share of ShopRite, it was 142 rand. The value went down. It was 142 rand. Meaning, if you have bought 100 shares in 2020, your portfolio will be looking like this today. It will be 142 times 100, which is going to be 14,200 in total cost. In other words, for you to buy 100 shares, at the value of 142. It was supposed to cost you 14,200. And then as the current price now, it is 367 rand 63 cent. Now the value of your money, it will be 307 rand 63 cent times 100, it will be 30,736 within the period of 2020 up until now. You can check these calculations which I'm giving you. No bank can be able to give you this amount if you invest 14,000. You can't get this kind of amount. And I'm not like, even if now it's the value of your money is now 30,763, I doubt you'll be having the mind of withdrawing it, because Shoprite is still growing. And this investment, I believe that we're doing this investment is either we're doing it for our children or we're doing it for our retirement. Now we still have time to say, let me allow it to grow. So now it will be dated, 30,763 plus the dividends which I've received, which I've never included them when I do my calculations. So in other words, you'll be minusing the 14,200 which you bought the shares with, and then you'll be left with 16,563, and then it means your capital gain will be 16,000, but the total overall of your money will be 30,763. That's how it will be by today if you have bought these shares during the COVID season. And then the question is it the right time? Like, because people will ask, okay, you can still buy them. It depends on what is your goal. Are you planning for a long-term goal? If you're planning for a long-term goal, obviously, it's a sure thing that Shoprite shares don't continue to grow. It's a sure thing. Why? It's the number one retailer in South Africa, and it's the number one retailer in the whole of Africa, and it's the number one supplier in terms of food with cheap prices. You know, the thing which Pick n Pay needs to learn from Shoprite is in terms of pricing, in terms of organizing their business. Now, if I was talking about business, I would say let's use Shoprite, compare it with Pick n Pay, and study the things which cause Pick n Pay to fail, and then study the things which makes Shoprite to prosper, and you start business in the back. Because we're doing shares, let's focus on shares. So simplicity, that's how it is. Now one share is 307 rand 63 cent, but during COVID it's 142. But because Shoprite is a retail company which is fixed on food, you can continue to pounce more in terms of Shoprite. Now I used to have this mentality. For me, I'm no longer going to use that strategy of back in the days of saying, let me put 500 in Shoprite, 500 in Capitec. But I said, nah, this thing is not working, boss. For me, I was enjoying to see many companies in my portfolio. But I said, no, I just need to have a fixed time to say, for the whole 6 months, I just want to focus on Shoprite. Every month, I'm going to put 5,000 aside to buy Shoprite shares. It's an example. I don't mean to say put 5,000. It depends on how much you're having. I say, okay, for this whole 6 months, I'm going to put 5,000 or 10,000 every month in Shoprite. And then when I'm done with Shoprite, what will be? I need to have my list, and then draw down my list and say, what will be next? MTN. Then I go for MTN. The next 6 months is MTN. I go for that. In individual companies, remember we spoke about ETFs from the beginning. So now I'm talking about individual companies. So you'll have now your own target to say, I'm targeting this company for this period, and then later I'm going to target this company for this period. It's up to you which one can work for you. But for me, that thing of saying, I just want to buy more companies at a less amount and having more companies in my portfolio, I felt like it was not saving me good, because I'll have this lot of companies, and if that time I had managed to calculate this man and put it in one investment, it could have made sense. So that's the thing. And I said, no, let me just change the strategy, because strategies can be changed at any time. So let's check the type of a stock. The second type of a stock which we can invest. We also have what is so-called a preferred stock. We also have a preferred stock. And then let me just explain the preferred stock. Some of those notes, I'm not going to share them on the screen because of the notes are going to be too much. So preferred stock represent, okay, and yeah, I don't know. Some of you who have already opened their investment account, have you noticed that sometimes you can search for Capitec, and when you open Capitec, you'll see that there will be 3 Capitecs coming out. And then maybe it can be confusing to say, what's happening, because now I have three Capitechs now. I want to explain to you what's happening there, and it's not a mistake. I don't know, because Capitech has also preferred stocks. So preferred stock represents some degree of ownership in a company, but usually does not come with same voting rights. So with preferred shares, investors are usually have a guarantee fixed dividend forever. So when you own a preferred stock, the dividends are fixed. So usually people who are buying preferred stock, they are not buying them to make money through capital gain. A capital gain is a growth of that investment. They are aiming to make money through dividends. So they are looking for an income. So they know that if I own X amount of shares in this company, the dividends are fixed. And then I'm going to get this X amount at the end of the day. They know that. So okay, with preferred stocks is their fixed dividends are fixed. If they say we're going to pay 200 per share, no, that those dividends is a must for them to pay them. So this is a difference between the common stock and the preferred stock. So preferred stock prices are less, like they are less volatile than common stock prices, which means shares are less prone to losing value, but they are also less prone to gain value. So with preferred stock, these companies, hey, they grow slow, guys. Hey, these ones, they grow slow, very slow. So if you're going to invest in preferred stocks, know that these companies, they grow slow, but they don't lose value easily. But the issue with them, they grow slow and they have guaranteed dividends. Their issue is that they grow, their growth pace is very low. So if you're going to invest in preferred stock, it means you are going there for dividends. Don't go there if your plan is not to get dividends, because you will be surprised. Now this thing is not growing, and then you'll be swearing there. It's because it's a preferred stock. So a preferred stock, you notice that the preferred stocks, they are growing in a less rate. Even if you can go to companies like Absa, like when you search a company, you discover that company, it has 3 companies. They also have preferred stock. So the preferred stock, they grow less in value, but they have fixed dividends. So let's just look at an example of a preferred stock, and then we'll go to the next stock. Okay, an example of a preferred stock is Capitech. Capitech. So Capitech, don't be surprised. Capitech, as I've said to you, Capitech is divided into three, I think 2 or 3. So you'll have the preferred stock of Capitech, but you'll also have the common stock. So the preferred stock of Capitech, you'll be surprised. The preferred stock of Capitech, it has been on 100 Rand for a very long time. And then it has lost value. It has lost value of 0.89% since it has started to trade. So it didn't grow. It lost value of 0.89%. So mean the value of that preferred stock of Capitech, it has went down instead of going up. It has went down because it's a preferred stock. But in terms of dividends, it has been performing well. As I said, if you wanna go for preferred stock, you must go for things which you must have the purpose of saying, I'm investing in this company with the mentality of not making money through growth, but making money through dividends. So you must have that mentality. And then the third kind of stock, which I won't display it on the screen, I'll just display it on my notes here. We call it a growth stock. So a growth stocks are shares in companies that are expected to grow in revenue earnings in a faster pace than the overall market. So the key features in terms of this growth stock, they have high growth rates. They have good reinvestment strategy and marketable. So the example of a growth stock is again Capitech, but now it's Capitech Holdings. It's no longer Capitech as a preferred stock. Hence, I say to you, if you don't understand these things in terms of being a preferred stock, a growth stock, just look at the pricing. The common stock of Capitech is 2.4, but the preferred stock of Capitech is 100 Rand. So the 100 Rand one, you won't be making money in terms of growth. The 100 Rand one of Capitech, you'll only be making money through dividends. And then the question which I ask you, Is your plan aligned with the Capitec strategy in terms of their preferred stock? If it's no, then don't go for that one because you'll be struggling. That one, investors invest in it with only one goal, that want to make money in this preferred stock, getting dividends. So there are a lot of preferred stocks. And that's why I've said to you, don't look at these things listed, then say jump in and buy. There are a lot of preferred stocks. There are a lot of preferred stocks. So you need to make sure that you don't just jump into any stock. You need to ask, this is a preferred stock, or is it a common stock, or is it a growth stock? Then we'll explain to you, no, this one is a growth stock. It's not a preferred stock or a common stock. So when you speak of growth stocks, you speak of companies which are listed there with they have the capacity to grow. They have the capacity to grow, and their growth rate will be in a higher pace. So we call that those companies growth stocks. So the growth stocks example of it is Capitec, not the Capitec which is on your screen, but the Capitec which is in my screen. So okay, let me just say, have you ever noticed something that if you want to send someone money, they'll be like, they say, no, I want to send you money. They'll be like, do you have Capitec? Like as if Capitec is the only bank that is existing. Like if you want to send someone money, like, do you have Capitec? That's it. And the fact that you hear many people say, do you have Capitec? It shows you that Capitec, it is making more money through black people. And then there are a lot of black people because Capitec is created in a sense that it makes the consumers to believe that Capitec is cheap. And then many people, they have this mindset that Capitec is cheap, but if you start the movement of Monday, you'll see that, nah, nothing cheap here. But the way it was staged in that sense that people, they believe that Capitec is cheap, and then that's how they make a lot of money. So the growth of Capitec is going to continue to grow because people are preferring it. Many people are preferring it. One of their strategies which is working for them is that they've created Capitec to be easy. Capitec is an easy thing. You look at their app, it's not like a jargon, like so it attracts many customers. So the more people jump into Capitec, is the more the value of investment in terms of stocks growth. But the funny part is this: we have many black people who are owning a Capitec account, but minority, they own less investment in Capitec. They don't own the shares, they only own the cards. That's how funny it is. They have Capitec bank accounts, but they don't own Capitec shares. So I rather own Capitec shares than not owning a Capitec account, because I know when you put money there and make all those transactions, my growth is also growing. Like my investment is growing and I'm making more money. So I just want to explain to you the background of Capitec. And then you guys who are having kids who are under 18, you can open minor accounts at Capitec, and then after opening the minor account at Capitec, open the minor account on an easy equity for your child. So you will be having your own account, your child will also be having his or your own account. So both of you become investors, or the whole house become investors. And then you teach them in a simple process that, okay, Tabo or so and so, this month we're investing, like make it like as a habit in the house to say investing is our family culture. It's our heritage. We invest as a family. So you can open them in minor accounts and then allow them to have also minor investment accounts in terms of easy equities. It's doable. They can have their own accounts. You can also have your own account. It's as simple as that. So let me just give you a brief overview of the Capitec shares. So Capitec, it was founded in 2001, a simple bank, 2001, but it's growing higher than all those companies that you know. So I want to give you the background of their market. I just want to share how they started. So when Capitec started to sell their share, their share, it was 2 rand. One share, it was 2 rand at Capitec. So if one share it was 2 rand, for those who had their foresight to purchase just 500 shares at their initial price of 2 rand, their investment of 1,000 will now be worth 1.2 million. So if back in those days of of Capitec being listed at JSE. If you have bought those shares at 2 rand, you'll spend 500. You'll spend 1,000 to get 500 shares, which now the value of that money will be 1.2 million. Now, by now, it will be 1.2 million by now. And then people will be asking that now, if now I jump into Capitec and start to buy those shares, will I able to make the same money? The answer is the answer is it will depend on the growth of Capitec, but because of how they have strategized their business, Capitec is growing. Even though people can complain about networks and everything, they will never leave Capitec. Capitec is like that abusive boyfriend who will abuse you today and buy you romantic gifts tomorrow. And then you see, no, but I can't go leaving these gifts. That's how they operate, you see. So you will be enjoying and say, mara Capitec ya bora, but mara itakuya kuna banking one. You come back again. So you'll complain about network, you'll complain about queues and say Capitec have long queues, but Capitec knows how to romanticize you, buying you good gifts and giving you all those and say, where can I go? Let me stick with my Capitec. I'll just have an FNB account on the side while having Capitec on the side, and you stick there. So definitely Capitec is going to continue to grow. Definitely Capitec is going to continue to grow. And then investors and guys, you have to understand this. When they say one share at Capitec is 2,400, you don't need to have the 2,400 to own the shares there, because there is what is so called they allow the easy equity allow you to have half ownership. I just want to use a simple language, not those complex language. They allow you to have half ownership. Let's say when you have 100 rand. They allow you to own those shares of 2.4 with 100 rand. So you will be all owning the value of 100 rand of 2.4. So that's how they don't wait for you to have the total amount. For my younger sister, I've used that strategy to say, okay, even if you don't have the whole amount, let's just buy half of this share. And then buy half of those shares, making good progress, because he also started to invest long time ago. So we'll just buy half of those shares and buying half of those shares, and then when she get the NSS money, we invest there. We're like, it's a strategy. And black people, when they get the scheme fund money, they think of buying good pizza. And then now they want to squander their money because now they think they're billionaires at school. But we can start to prepare from them. They can start to prepare from that level, helping like growing their income. Like, guys, I want to challenge you. Like almost all of us who are here, we are having kids. I want to challenge you that don't allow this year to pass without your kids owning shares at any company. Even if it means they invest 100 rand in a month, it's okay. When now what you'll be building a culture of investors. Even if you are no more here on earth, your kids will continue to be great investors. Let's stop this mindset of saying, nah, I don't want my kids to grow up the way I grew up. And then you say that by buying them expensive sneakers. I'm not saying it's wrong to buy those things, but the thing is this. Better to have a strong mentality and strong financial background than to have an appearance which appear to be majestic while you are suffering inside, and then you don't have anything even in your bank account. I always push myself to this level that I don't like. For me, I grew up. My parents were working when I was born. I've watched them at every step that they went through. I said no. Now I'm pledging. I am the last person. I'm the last person to write something called a CV and to apply for a job. I'm the last person. I'm the rest that are going to come through me. They will never apply to anyone, but someone will apply from them. And if I want to achieve that, I need to own the means of production. I need to own the means of production. In fact, we must also have a session where we can speak about things which we can use to own the means of production. Besides the stocks, it's okay to speak about the stocks, but we also need to have a session where we speak about alternatives which you can use to build other streams of income and alternatives that can help us to be wealthy. I don't want my child to go to sit in a certain table and they say, Miss Koza, tell us about yourself, and she'll be lying. I'm a hard worker. I wake up at 6 o'clock. Even in rainy days, I can come to work. I don't want that. I went through that process, but it's over. I'm now bridging a new gap. I mean, I'm now bridging a new path for my generation. There's a new will be a generation who think differently. We own the means of production. We own, even if it means, guys, even if it means like let your children own something of value. Like, it's okay for them to own gadgets, but let them own something of value. Own land somewhere, own one room, even if it's one room, as long as it does have value, let them own something. Let them own something. So I'm challenging you guys that let's push them to that level. So when these guys of Capitec started, it was only 2 rand. And then many people, I'm sure they were like, oh, company of 2 rand shares, where is it going? But that 2 rand today is making a lot of sense. And I'm telling you, these guys now, teach your children the value of money. There is no such thing as small amount. That 2 rand has made others to be millionaires. Even during the COVID-19, when the shares dropped down, still they made a lot of money, people. That small amount which people are not counting, as I've said to you, we had the opportunity to buy. I was there, having the access to buy the Time Bank shares at 50 cents. I was there. I also had the opportunity to buy the Easy Equity shares at 50 cents before they even went to 3 rand and went up. I was there when they were 50 cents. So let your children think of money differently. Let them see money differently. And I'm urging you again, before I jump to the other type of a stock, don't allow this year to pass without your child owning something of value. Open the minor account for them to buy shares. Even if they can invest 10 rand in a week, it's okay. The thing is that the money is not just sitting somewhere being wasted. The money is growing. And as far as they grow, they have the advantage because they have an advantage of time. They're still young. They don't have responsibilities. You are building a culture. When I forget about that, I don't have too much money. Think of the culture that now you're building a certain culture. You know, there are some families where people are so proud and say, nah, I'm like my father, man. I have many kids all over. No, let's have a culture that's also going to boost and say, I'm like my father, I own shares. I'm like my father, I own businesses. Let's have that culture also. We can't focus on negative things with that. When you think of black people, it's all about the negative things. They own this, they what for this, and then black people are no. Let's also bridge a culture which is going to be in the negative, I mean, in the positive side of things. So the other type of a stock, okay, in your portfolio, please let's make sure that we have all these type of stocks which I've mentioned: the preferred stock, the common stock, the growth stock, and then the fourth one we call it a value stock. A value stock are shares of companies that are considered undervalued relative to their true worth. So a relative stock is a company that, I mean, is a value stock is a company which is selling less of its own value. So it's less compared to its original value. So such companies, these are the companies which make guys like Warren Buffett wealthy. So they are trading at a lesser value, not on their original amount which they were supposed to be sold at. So they are trading less. So these companies, they give advantages, like you find something they say is 6 rand 99, but now because of sale it's 1 rand 50. So they are selling less. So we have those companies. And then for me, I also have the company called the SABC Zenzele. It's a South African breweries company. So now we are going to Christmas. Those guys who are buying booze, they're helping us to grow our portfolios. Though sometimes we pray in our prayers, God help them to stop alcohol. But if they stop to drink, hey, some of us, our investments are going to suffer. So I don't know how to pray for them. But we have SABC Zenzele. Those are SABC, the South African breweries shares. So they were trading this for a very long time. So the reason why we bought those shares, it was because of dividends. They're trading this, but they are growing. As far as we have many people who are drinking a lot of alcohol, we have those shares, and don't continue to drink. Though we have some Distel is also another company which is listed there at the JS, which also deals with alcohol. So you know things like alcohol, they are number one in our country. So you also invest in such companies because you know people will continue to consume alcohol more and more. So I'm not saying we must buy alcohol. I'm just saying we invested in alcohol companies. We know that people will continue to buy alcohol. So such companies that are trading less, but in terms of growth rate, they are growing at a lesser rate. So also have dividend stocks. So dividend stocks are companies which we focus on getting more shares on them. Example of a dividend stock is MTN. MTN as MTN network. What I've noticed about MTN is more dominant in Africa, not only in South Africa. MTN is more dominant in Africa. You'll notice that if you cross species, you go to your Nigeria, you go to your Zim, you go to your Mozambique, you will see that they're using MTN. They also use MTN. So MTN, they're dominating. They're dominating because they are also in communication business, but they are also in terms of like phones. So it's a big company. But for me to invest, in fact, MTN was my first company to start to invest in, with the aim of getting dividends. And MTN, they pay good dividends. Sometimes they pay dividends plus special dividends. So if they say they're going to pay dividends plus special dividends, in other words, they're going to get these dividends and extra dividends. So MTN is one of the good companies if you're going to invest in dividends stocks. But a lot of companies which are also dividend stocks, but one of them that I prefer most is MTN. And then we also because we have disadvantages and advantages, but I'll skip that. We also have blue chip stocks. So blue chip stocks, these are large established companies. So these ones, you speak of companies which are well established, that even if something happened, it's not easy for these companies to fall. So an example of a blue chip company is Anglo American. Anglo American, in terms of growth, it has been doing well. Those who have invested in Anglo American, they will testify. It has been doing well. And Anglo American pay good dividends too. So Anglo American is established. So when you speak of blue chip stock, you speak of companies which are well established, well balanced, that even if COVID can come, those companies can spend more than 6 months without working, but they still have stability. So blue chip stocks are companies like your Anglo American and other companies that are well established. Even Shoprite falls under blue chip stock market because Shoprite is well established. Even if something happened here, Shoprite can still stand and be able to function. So when you have your portfolio, you have companies which are still at the lower value, which are value stocks. Have companies which are blue chip, which are well established, to balance your portfolio, so that when this one is not doing well, this one will be able to bring value in your investment. And then the last one, we have penny stocks. So penny stocks, these are stocks which are selling at less than 5 rand. So any company that is selling stocks at less than 5 rand, we call it a penny stock. But the issue with penny stocks, some of them, they take time to grow. Some of them, they don't grow at all. So we do have 2 years back, I used to have a challenging people as let's pick penny stocks. So penny stocks, some of those stocks, we bought them at 10 cents. Yeah, penny stocks, you can get them at 10 cents, 20 cents. Even today, we still have those companies which are selling at 10 cents, a share at 10 cents, 20 cents. They are penny stocks. But penny stocks, you must know that they are also high risk, because you can spend years without seeing any growth in those companies, or some of them, they cannot grow at all. Because there were guys who were back, I think not last year, 2 years back, they were suggesting that no, people must buy Labad, because those guys, they will be the one who will be taking the trend of renewable energies, and people went and buy. But when you look at that thing today, it's still down. It's still down even today. So hence I say, we don't follow emotions here. We need to be informed. So these are the types of stocks which you need to have, or these are the type of stocks which you are having. So we have the penny stocks, which are stocks which are selling at less than 5 rand, and we have the dividend stocks, which we only aim at getting dividends. We have the value stocks, we have the preferred stocks, we have the growth stocks, we have the common stocks. So your portfolio must be balanced in this way. It must have 7 colors in it. It must have 7 colors in it, that all of these companies are there. So now, because most of you are starters, it's okay for you to ask when you want to buy these stocks and say, okay, this one, where does it fall? So that you know that, some people, they also have diaries where they write their holdings and say, I have 5 shares which are under a value stocks, 5 shares. So in order for them to keep their record, to track their record, so you can also have your own balance depending on your strategy which you want to use. And remember, guys, my strategy cannot be a strategy, but all of us need to have our own strategies that is helpful to help us to grow. So have balance, have 7 colors in your portfolio. Don't just have one color and you only go for dividend stocks or you only go for common stocks. Just have these 7 colors in your portfolio, but build it in pace. Have targets. Targets companies and say these are the companies which we are going for this month. So okay, what I'm going to do also, I'm going to share on the group. I'm going to share at least, which since there are 7, I'm going to share two companies, 2 preferred stock, 2 common stocks, 2 penny stocks. Those that I think if you want to go for, you can go for. I will also share that on the group, that these are the companies which you can go for. So, but now this month, I will urge all of you who have already opened your investment account, start to buy Shoprite shares. Start to buy Shoprite shares now. As for this month, when I say this month, I'm talking about the month of October because they're already on October. So start to buy Shoprite shares. If you have them, please put more efforts to grow them, to buy more on them. And then we can have your Shoprite, we can have your MTN. For dividend's sake, let's have Shoprite and let's also have MTN. These are the 2 picks for this month. And then we can have our 2 picks next month to balance. Now we pick 1 common stock, and then we pick 1 dividend stock, which is MTN plus Shoprite. So let's go for them, and then let's put good money there, and then let's put this thing. So I don't know if there is anyone with a question, or if there are questions, so that I'll be able to answer you, and then we push this wheel going forward. So most of these things which I was sharing, they are in my book, which is going to be out this weekend, this Saturday. So you can learn more. If you're a reader, you can buy that book and learn more, because that book also covers stuff like marriages, how marriages operate and how they can affect your finances in terms of law, not in marriages like in my head, but in terms of law, how the law classify marriages, that this one, as they classify it, if this happens to you, this is going to happen to you. And also have stuff like money love languages in a relationship. We have 5 money love languages which I spoke about in that book, that you can learn about in terms if you're having a partner. I know most of us have partners here, and then we fight about money. We have to resolve those stuff, because you have to understand money languages of our partners. So I see a hand there. You can open your mic and ask the question. I saw a hand. I think it's Siyabonga, something like that.
Okay, it's Siyabonga, Mr. Koz.
Yes.
So I wanted to ask, there is this company, EOH Holding. So it was one share, it was, I think it was 200 or let me say above 100 rand. Now it has dropped to 1 rand. So I want to know, is it classified as a penny stock, and will it be able to grow or what? I just want to know that. So yeah, I hope you understand me. Thank you.
Yeah, so to give you an accurate answer, I will need to research about that company and study their financials, and also studying the factors that led them to go down. Because the company can be up and going down. It's like, it doesn't mean when it's up and going down, it's not a penny stock. It is on that level, but now it just went down because of some factors. So I will need you to send me the name of that company, then I will do my research and analyze it for you and explain what happened to that company. Okay, thank you very much. Any question? Another question coming? Do we still have questions? Okay.
Oh,
Yes.
okay. Also,